So fractional reserve banking is a pretty simple concept. It's too bad I don't have a blackboard. This would be much easier with a blackboard. But think of it this way. You deposit your money in the bank, and the bank then takes that money and it lends some of that money out. So if you were the only deposit in the bank, you would say, well, wait a minute, it's lent the money out. What if I want to withdraw all my money? It's not there anymore, which is true. It's not. A fraction of that money is now being lent out, and the bank can't access it easily. So actually, if you read the fine print of your checking account, it actually says that the bank is not obliged to provide you with all the money in your checking account whenever you actually want it. They can actually freeze you out of that account for a certain amount of time until they can get that money from the person they lent it to and return it to you. And, you know, if you read the fine print in the contract, no bank is contractually obligated to provide you with all the money you want whenever you want it. Now, why isn't this a continuous problem where I want to withdraw money and it's not there? Here you get to a statistical phenomenon, which is called the law of large numbers, and that is that if enough people are depositing money in the bank, and if the bank is not lending all of it out, but lending a certain fraction of it out, then you can come up with a number when 99.999% of all the times where people want to withdraw money, they will actually get their money. The bank will always have enough money in their vault in order to provide it to you. And the bank can then take whatever fraction they have calculated and lend it out and feel pretty comfortable, because some people are withdrawing money, but then other people are depositing money. And almost never is the case that the bank has no money to give out. In addition, in more modern, sophisticated, complex financial markets, the bank, if it is in a liquidity situation where people are withdrawing money and they don't have enough money to provide, they can go out and borrow money on a short-term basis to provide the withdrawals. That's called fractional reserve banking. It's the idea that of every dollar you deposit, a certain percentage of that is lent out. In free banking, in an era where the government does not provide deposit insurance, where the Fed does not determine how much reserve the bank has to maintain, in a free banking era, banks varied how much of your deposits they would lend out. And this is, by the way, how they make money, right? They give you an interest, let's say they give you 1%, and then they lend the money out at 4%. They've got a margin of 3%. That's their profit. In an era of free banking, what happens is some banks lend out 70% of the money, and they kept 30% in reserve. Those were pretty risky banks. And you as a depositor would demand a high interest rate from them. So they would actually, in order to get you to give them money, give you a high interest rate. And then they would make relatively risky loans because they would have to make up in order to make a spread, in order to make money. There were other banks that were well known as 100% secure banks, right? So they would have 100% reserved. They wouldn't lend out anything. And there they would give you no interest, or very, very low interest, in order to get you into the bank to deposit their money. Now you'd say, how do those banks make any money? They make money on your saving accounts, because you see, in a saving account, you put your money in the bank, let's say for a year, it's locked in for a year. Now the bank can take that 1 year and loan it out to somebody for a year. And they're matching their assets, which is the loan, and the liability, which is what they promised to give you. That is a almost riskless bank, right? The risk is really that the loan will default. The risk is not that they will get into a liquidity crisis. But again, those banks on checking account deposits paid no interest because they weren't making money off of your checking. They were providing you a service. And actually, those banks charge you a fee to deposit money with them. So you have this spectrum. In a free market, what happens is you have a spectrum of banks. Some of them have no fractional reserve, have no fraction that they're lending out. Some do use fractional reserve banking, and they keep some on deposit. That is public information, and that really determines the level of the riskiness of the bank and how much interest they're willing to pay for you. And if you're willing to take on risk, if you're willing, and what is the risk you're taking on? The risk you're taking on is that when you want to withdraw your money, the bank won't have it. If it's a large bank, that risk is very, very small, but it exists. But that's a risk you know in advance. It's contractually in the contract says that you don't always have. So there's no fraud here because it says we're going to lend the money out and you might not have access to it for 2 weeks, for a month, or for whatever. I don't see any problem in fractional reserve banking from a rights perspective, from a fraud perspective. Now, a lot of Austrian economists and libertarian economists criticize fractional reserve banking because it creates uncertainty in terms of the quantity of money in the economy. Because what happens when you deposit money and the bank then lends money out, there are two claims on that same money, right? So in a gold standard, you put in $500 worth of gold bars, and then you now have checks that you can write on that $500 gold. But then that gold now is lent to somebody. Let's say 100 of that is lent to somebody. So there's another 100 over here. So you have 500 and they have 100. Suddenly there's more money in the economy. How that grows and shrinks is very volatile and uncertain. So it creates a certain riskiness, a certain uncertainty about the quantity of money in the economy. And maybe some Austrian economists will talk, that's not optimal because it creates booms and busts. So has the potential to exacerbate or even to create booms and busts. I would argue that as long as no rights are violated, who cares? So yeah, maybe it does create more volatility in the economy, but we're not about economics. We're about rights. We're about what's right and just. And if people agree contractually to fractional reserve banking, there's no reason to ban it. There's no reason to be opposed to it. You could criticize it from a purely macroeconomic perspective, but I think that's probably wrong. I think if we actually analyzed it, there are certain benefits to fractional reserve banking. I think what actually happens is it provides more flexibility in the economy. It allows banks and financial institutions to adjust to changing and varying economic conditions in a way that they couldn't with a rigid non-fractional reserve system. But I'm not a professional economist, so I'll leave that debate for others to have. But again, from a purely rights perspective, from a freedom perspective, there's nothing wrong with fractional reserve banking as long as it's contractually recognized when you open up a checking account.